Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. On Friday, the Fed just pulled the most anticipated trigger. I'm going to show you what they're planning to do and the reasons behind it, and more importantly, what does this mean? Is it time to get out now? Does rate cuts send stocks even higher, or just the opposite? Today, we are getting to the bottom of this. The real truth behind why the Fed plans to cut rates in September, and it's confirmed. When the stock market is more or less back at an all-time high, are we getting a soft landing, meaning back to normal stage, or something is making the Fed terrified, and they have no choice but to cut rates? Powell says the time has finally come for the Fed to cut interest rates. This is something that we know that Powell wanted to do because at the last FOMC press conference, he suggested that he wanted to cut rates, but the challenge is he didn't have the full support of his board, so he's using his position as the leadoff speaker at the Jackson Hole Symposium to set the stage.
Take our time and get this right. And that's what we're planning to do.
So September?
I'm not going to be landing on any specific dates here today. Let me also say that we're well aware that if we go too soon, that we could undo the good work we've done in bringing down inflation. And if we go too late, we could unnecessarily undermine the recession, the recovery, and the expansion. And so we're aware that we have two-sided risks now, more so than we did a year ago. That's a big change, I'd say.
To let them know that he is ready to cut rates and to plan on it at the next meeting. The time has come for policy to adjust, he said, as a direction of travel is now clear. And the timing and the pace of rate cuts will depend on the incoming data, the evolving outlook, and the balance of risk. But what is the real truth here? Why is Powell so eager to cut rates? We're going to take a look at the underlying economy, and you're going to find out why Fed Chair Powell is extremely worried. The Fed chief also acknowledged recent progress on inflation, which has resumed moderating in recent months after stalling earlier in the year. He says, "My confidence has grown that inflation is on a sustainable path to 2% as the central bank's target." But what is the metric that he's using for that? Because not long ago we heard from him and the other speakers that they were worried about inflation resurging.
The United States is running a very large deficit at a time when we're at full employment, and it just is, the level of debt that we have is not unsustainable. The path that we're on is unsustainable. The last part of last year, people were saying, you need to declare victory, this is over. And then we had a quarter of inflation, which was well above 3%. So
now he's convinced it's on a path to 2%.
Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%.
Perhaps it has everything to do with the labor market.
And the downside risks to employment have increased.
Which is what we're seeing now as a shift in the tone from the Fed. As we look at the consumer price index in blue on a year-over-year rate of change and the unemployment rate in red. And what do we note? That as unemployment starts to rise, you can get transitory increases, inflation, but it comes tumbling down afterwards. And this makes perfect sense because as people hit the unemployment line, their incomes go down, and so that they have less money to spend in the economy. That leads to what we see from retailers and wholesalers who need to start marking inventory down to get it out the door. And so what you see is, as the market starts to realize that the labor market is falling apart, inflation comes down, and the problem now is we heard not too long ago from the Fed chief that he thought the unemployment rate would stop somewhere around 4.1%, but now it's at 4.3%.
Including the risk of unwelcome further weakening in labor market conditions.
The fear is it's going to continue to go higher. Inflation is not going to be the problem. It's going to be a recession. Odds now remain steady for a quarter base point cut in September. And while the Fed presents that they are independent and they are the on-setting policy, they look to the bond market and they want to see the bond market is telling them that yes, you need to cut rates. And this is how much. Of course, it's only the bond market is being truthful, telling us deflation is coming. Because the stock market is partying like 1999 again, and they all think we are in 1995. We will find out how long this rally can keep up next Wednesday when the beast NVIDIA stock reports. If you don't already know, this whole market is driven by the Gen AI story. It's a movie, and NVIDIA is the superhero in that movie. Wednesday night, we shall see where this market is going. You can see how many people were on that yen carry trade on that Black Monday. NVIDIA crashed like 15% that day. Of course I was buying the dip. Because of my art of trading senses kicked in, you have to buy those huge red days and hold them. Don't let the volatility shaking you out. Holding on tight to those shares because the AI hype won't just go away unless the rate cut reveals real recession fear. I bought the dip on NVIDIA stock at $92 and currently riding it up another 40% for just 3 weeks' time. If you want to see every move I am making in real time, join my Art of Trading Club on my website link down below. We are doing really well. My Honest stock is up over 200% in a year. NVIDIA is always a great swing trade. Even my Roku stock is 12% up on Friday. Thank you, Jay Powell. Woo-hoo! As he said, F your puts. This is why the stock market is totally different from the real economy. So where is the fear? Why is Jay Powell trying to keep the stock market up as long as possible? We do not seek or welcome further cooling in the labor market conditions, Powell said, adding that slowdown in the labor market was unmistakable. Now this is the fear they brought inflation down, or at least they're taking credit for it. And now we're seeing the labor market start to unwind, and this is exactly what happens when you constrain demand. You start to see things falling apart. Because when we look at what's going on here, we see the unemployment rate is starting to frighten the Fed chief. And he really wants to cut rates here because he believes, and the bond market believes, that if you cut rates once or even twice, maybe even a little bit more, that's all the economy needs, is that monetary policy here is far too restrictive. But when we look at history and not what happens at all, the problem is once you start to see the labor market fall apart, there's virtually nothing the monetary policy makers can do to stop it. As we look at the federal fund rate in blue against the unemployment rate in red, what do we see? As the Fed starts to cut rates, it doesn't actually stop the trend of unemployment. In fact, it starts to accelerate it to the upside. You see that happen here again. In the dot-com bubble, unemployment rates started to rise. The Fed gets nervous, says, well, we need to cut rates, and the next thing you know, they're just plunging. As the unemployment rate goes higher, it happened again going into global financial crisis. You can see very clearly the unemployment rate rising. The Fed starts to react, and then it's too late. Right now, that is the fear the Fed has, is that they're too late to the party. Which is why, of course, Fed Powell wanted to cut rates last month. The issue here is, while the market believes rate cuts work, history shows they don't work at all. But yes, you got to keep it in mind. The Fed needs to keep up the allure that they're actually doing something. They have control over the labor market because their success or failure will determine whether there's a so-called, quote, soft landing. That's not possible. It never happened before, and this time is no different. If you don't think the Fed chief knows at all, he does. That's why he wants to cut. Smothering a burst of inflation without tipping the economy into recession is impossible, and that's a key point because every time we bring inflation down off a relative high level, eventually the labor market goes. Because you think about it, how do you bring inflation down? You have to bring demand down, and if you bring demand down, well, you don't need as many workers, and the next thing you know, the whole thing snowballs apart. Powell saying, look, I brought inflation down. Now I need to keep the labor market from falling apart. I need to get some rate cuts here to show everybody around the world that we're doing our part to keep the economy floating. But the reason I wanted you to see that unemployment report against the Fed fund rate is because it never works. Not once, but yet they have to keep the poker face up. Because when we look at the consumer price index, you can see against continued unemployment claims, there's absolutely no question when you bring inflation down. You don't need as many workers. They get onto unemployment. There's no opportunities for them. They get stuck there, and further demand destruction occurs. You can see this going back to the mid-80s and early 90s. How about here, the dot-com bubble? Once again, the global financial crisis. And you see it now, there's really nothing changing here. Because if we were experiencing a soft landing, we might start hearing from employers that they're looking to hire. We might start to see continued unemployment claims going down a bit. But we're not seeing anything of that nature, and Powell knows it. And he realizes if he's too late to cutting rates, a quarter-point cut on September 18th was widely anticipated at this point. It's not going to work anyways, but remember, he's got to convince everyone it does, and then find something else to blame it on. Remember last time we couldn't get out of the house?
The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored.
Maybe it's time to get out, but oh wait, you don't want to time the market, right? Well, hold on tight and brace for impact.